Hello, my name is Troy White. I'm with Hoodoo Financial. Hoodoo spelled Hoodoo Financial. You can reach me at YouTube, Hoodoo Financial, at Instagram, Hoodoo Financial, all one word. The internet, www.hoodoofinancial.com. You can send me an email at twhite@hoodoofinancial.com. That's how you can contact me. All right, who am I and why am I talking to you? Again, my name is Troy White. I'm a finance professional, financial advisor, and portfolio manager with Hoodoo Financial. So I help people invest their money into the proper assets to achieve their goals. That's my job. So why am I talking to you? I'm talking to you because I want to tell you the great news. The great news is we got the technology that's outdoing everybody. And now you have the ability to invest like the big boys, but you don't have to be one of the big boys. And because you got me on your team, because someone other than me will be taxing you to have access to these investments in this platform that I'm giving you access to. You otherwise wouldn't be getting it. You otherwise going to have to be a millionaire to get it. So I got the plug for you, is what I'm trying to say. So, technology and information, and the technology basically allows the common investor to invest in portfolios, and and in this basically portfolio investing is something that was previously only available to not just the rich, the uber wealthy. That means you had to be majorly paid to even have access to this type of investing. But now you could be a small guy, a small fry, and have access to wealth management. These are portfolios that you're investing in, portfolios that are customized to match your goals and your dreams, and financial planning to achieve your goals and your dreams, to do assessments to identify how you are currently doing, if you are on track to get where you're trying to go. In addition, we have access to alternative investments that not only does it not, are you not, do you not have access through some other firm? Most people in America don't even have access to this stuff. Hey, we're the technological leaders, so and we're bringing the technology to you. There are a lot of people who have been in this industry for a long time. They just don't know that this stuff exists nowadays, and so you know we stepping up to the new millennium for the new type of investor. And you are a new type of investor. You're a new type of client that didn't previously exist, and the industry is not currently set up to serve you, because the industry is currently uh, devised in such a way that only investors with large assets, in other words, people with a whole bunch of money, are the only people who are being helped. Because in this current environment, or up till now, the only way that the firms make money is if people invest large amounts of dollars. We're changing the game. It's a new day, and it's here for you. So that's why I'm here talking to you. So what I wanted to talk about today are basically, I'm going to give you these 5 rules that will make a smarter investor out of you. And so that's basically what our firm does. Our one of our mottos is learn, plan, invest. So our format is to educate you on what's out here and what you need to do for your financial future, and plan it out, and then implement that plan and just go do it. So it ain't nothing to it but to do it. It's time to stop talking about it and start being about it. All right, so 5 rules for smarter investing. And let's just get into it. First rule is diversify. Do not put all of your eggs in one basket no more. What does diversify mean? That means don't put all your eggs in one basket. That means diversify your holdings. It means get a little bit of this, a little bit of that, a little bit of that, a little bit of this. We don't want to own too much of one thing, because if that one thing being a company, if that company were to go out of business, then that means your assets are out of business. That means you out of business. That means you broke. So if you have $1,000, how about we divide that in 10 slices and put $100 in each stock instead of taking a whole $1,000 and put it in one stock? That's diversifying. Second rule for smarter investing is to personalize. And what I mean by that is that understand all investing is personal. So what the guy sitting next to you at work and the woman sitting next to you at work do has no bearing on your life. The selections that this guy made in his 401k and that woman made in her 401k they don't have nothing to do with your life. She is a 26-year-old single mother. He is a 57-year-old married father. You are a single youngster, or something. Well, my point is that co-worker's circumstances completely different. This co-worker's circumstances, and when I mean life circumstances, their life circumstance don't got nothing to do with yours. The goals that this person have and that person have are completely different than the ones that you have. So just because they picked something that works for them, if you picked it, it could exactly be the wrong thing for you. So understand that no investment is good or bad. It's just good or bad for you. So this particular the return that person is receiving may be completely inadequate for you to achieve your goals. And it could be the return could that investment may have a risk level associated with it, that if you were to take that, then that doesn't even fit your risk tolerance and your time horizon for your investment return. So you're just picking that because someone said it was good. So you go with it. That's not the way to go. All investments are personal. What's good for the goose is not necessarily good for the gander. I don't know what a gander is, but I heard that saying, what's good for him ain't good for you. Put it like that. So that's number 2, personalize your investments. Number 3, reduce costs. You must reduce your costs of your investments. And costs creep into investing in a lot of different ways. And this can be tricky, but I'll just point out some of the ways that I suggest you. I'm not an advocate of you investing in mutual funds because I have a better alternative. I'm not saying I don't like mutual funds and ETFs, but I have a better alternative. And the problem is with mutual funds is that the fees are embedded in the funds. So you may even have heard of load versus no load funds. So you say, all right, I'm gonna go with no load. All right, that just means that that's the cost going in or coming out. So even if you find one that is no load, well, there is something called 12B1 fees that are embedded in mutual funds, and there are other fees that are associated with mutual funds based on the time horizon that you're in the fund. So you're gonna have to pay a fee based on if you jump in or jump out. So you need to know the fees associated with the funds you're in and how that relates to the account that you are holding them in, and how that relates to the investment time horizon that you have for your goal. And that is going to be very important in terms of the, the mutual fund that you select. But anyway, I'm talking about the costs. So there are fees associated with mutual funds. So also there are fees associated with the investment, with you making the trade. So some firms will charge you a commission and some will charge you a flat fee. At our firm, you have commission free trading. So we're not charging you that type of way. So, but even a discount brokerage may have a small fee. So for instance, I spent early part of my career at Scottrade, which is an online discount brokerage. I love that firm. And in fact, I stayed with them for many years. But even under their model, I'm just saying my firm is better than that. And that is because even using, so Scottrade has $7 a trade. So you could buy any amount of shares you want for just $7. That's pretty good. But imagine you're building a portfolio and every month you're buying several stocks. Each one of those stocks is going to cost you $7 to trade it. So I'll just give you I'm literally blowing that out of the water. And here's how. Because when you invest with our firm, you're investing in a portfolio of funds. That portfolio may consist of 100 different stocks. So if you were to buy shares in each of those stocks, even at a discount brokerage, then, okay, I just told you we're investing in 100 stocks. So that's 100 times 7. So it's going to cost you $700 just to place trades in this whole entire portfolio that we're building for you. So what I'm saying is if every month you only have $100 to invest, well, what you're going to do at our firm is invest your $100 entirely in your portfolio. If you were to do it even at a discount brokerage, you're going to have to chop that $100 into slices and pick as many shares as you can inside of each one of those stocks. And it's going to cost you $7 every time you do it. Astronomical. It's just you can't do it. It's just not. You can't beat it. You can't beat me on that one at all. So for stock pickers, it's helping you feel good that you're finally on a path to becoming an investor, and that's great. But after you have got over the excitement of now that you finally doing something, then you need to learn to do it the smart way and do it the cost-effective way. So reduce your costs. For every dollar that you save is another dollar that you can invest. And when it comes to compound returns, I'll give you for instance, when you invest $100 with us, you are investing that whole $100. If you were to invest that $100 at a discount brokerage, even if it's just $5 a trade, so that means you're investing $95. So the compound interest will take place on $95. But at our firm, your compound interest takes place on $100. Exponentially, that's a large difference over time. We could track it out. It's probably in the thousands of dollars by the end of retirement that you're cheating yourself out of by doing that. Okay. Reduce costs. Invest consistently is the fourth rule. Consistently. So this one is one of the most important because a consistent investor is using dollar cost averaging. What I want you to do is invest a set amount at a set interval on a set schedule. What I'm talking about, invest $100 every month on a fifth of the month. Invest $1,000 every month on the fifth of the month. If you only got $25, invest $25 every month on the such and such day of the month. You know, you get paid on the 15th, invest your money on the 15th. So invest consistently. And then I'm gonna add something in there just came to my mind is pay yourself first means invest consistently. That's pay yourself first has to be your mentality. Is that when I get a dollar, 10% of that dollar goes to me. And that 10% is what you're going to use to invest consistently. So you have to do that consistently. In order to invest consistently, you have to pay yourself first consistently. So those are the same thing, but what I'm telling you is pay yourself first. And with the way you pay yourself is to consistently invest in your portfolio. I ain't saying invest in the stock market, invest in your portfolio. I did not say invest in stocks, invest in your portfolio. That was the fourth one, invest consistently. And the fifth and final rule, minimize taxes. Minimize taxes. This dovetails on what I told you to reduce costs, because every dollar of costs that you reduce is another dollar that you have to invest. So every dollar you reduce in taxes is another dollar as well that you can invest, and or is another dollar that you save and keep for yourself. So minimizing taxes is a multi-pronged approach, and it's what we refer to as tax planning as part of your investing. So that's gonna mean you're investing in tax deferred accounts, tax free accounts. You want, so basically some sort of tax advantage account, some sort of a tax advantage investment vehicle, and as well taking advantage of the tax code. So let's start there. So taking advantage of the tax codes is part of these 5 rules in a kind of roundabout way, because I consider part of your being a smarter investor is also being an entrepreneur and also investing in real estate. And those two things have tax advantages with them. So real estate, there's a tax advantage of the interest tax exclusion. So as you pay a mortgage, there is a principal and interest portion of that mortgage every month. So that interest portion is the highest portion that you are paying early on in the mortgage. And you get an interest tax exclusion. So you get a break off, you get a tax break for that interest you've been paying. So that is a way to minimize your taxes. In addition, as an entrepreneur, a business owner, there are expenses that you will incur in your life as a regular person, not as an entrepreneur, not as a business owner, that you can deduct since you are an entrepreneur and a business owner. So these same expenses were to occur regardless, but since you are in this category of person, then you can use these expenses as justifiable expenses for your business. Another way to minimize your taxes. But as it relates directly to your investments, the way to minimize your taxes is by holding investments in tax advantaged accounts and holding tax advantaged investments, and then using your tax loss harvesting at the end of the year, as well as auto rebalancing. Those are tools that are available to you when you're investing at our firm. Those are tax loss harvesting and auto rebalancing. Those are very important for a savvy investor for your investment portfolio. If you're a stock picker, so what? you're not going deep. You're not getting busy with it, taking care of your financial planning and your portfolio building and your financial literacy. That's what we all are all about. So again, to summarize the 5 rules for smarter investing: 1, diversify. You got to diversify your holdings. Don't put all your eggs in one basket. 2, personalize your investments. The reason you invest is to achieve your goals. Your goals are different than everybody else's. Your personal circumstances are different from everyone else. Your time horizon is different from else. So your investments are personal to you. They will or will not achieve your goals. That's all that matters. Not what the next guy is doing, but how this investment pertains to your life. 3rd, reducing costs. The more money you save, the more money you have to invest. The more money you have to invest, the more compound interest can occur in your accounts. Invest consistently. Remember, dollar cost averaging. That's investing consistently on a regular basis improves your overall cost and improves the number of shares that you buy over time. Dollar cost averaging, especially when you dollar cost average into your portfolio versus into an individual stock. You are knocking them out the box when you do that. And then minimize taxes. It does tail back onto the concept of reducing your costs, but I'm separating taxes from costs. Taxes is something that it's a hand digging into your investments. So we want to minimize the amount that they can dip into at all times. So those are the 5 rules that will help make you a smarter investor. If you need help in implementing and strategizing and planning, then please contact us. Contact myself, T. White at hoodofinancial.com. Check out the website. Open your free account to access portfolio building, commission-free trading, fractional shares. You can go to our website and open an account. Cost you nothing to get started. And our website is www.hoodofinancial.com. hoodofinancial.com. Check us out. Holler.